Welcome to the Stephens Investment Banking Energy Transition webinar. We are pleased to have as our moderator today, Len Vermillion, Editorial Director at Hart Energy for the publications Oil and Gas Investor, E&P Plus, and Midstream Business. Len will be speaking with our distinguished panelist. Maximo Blandon, Managing Director in Energy and Clean Energy Transition Investment Banking at Stephens. Stephens Investment Banking has been active in the energy space for 30 years. Chris Kendall, President and CEO at Denbury. Denbury has recently expanded its strategy from a focus on traditional carbon dioxide-based enhanced oil recovery operations into carbon capture and storage. Chris Leary, an investment partner at Orion Infrastructure Capital. Orion Infrastructure Capital solution factor in the environmental impact of companies. And Thomas Spangler, Executive Chairman, and Donald Buckley, CEO, both at CleanBay Renewables. CleanBay's portfolio includes poultry-based bioconversion facilities.
Hello, I'm Len Vermillion, Editorial Director with Hart Energy. I'm pleased to be here with Stephens and these industry-leading experts on energy transition. Let's begin today by turning to sustainability and ESG goals. This question is going to be for everyone. So there are a dizzying number of factors for oil and gas demand, renewables, and the power generation mix. I want to know, how has this energy mix and its related deal flow changed your business? And how do you see the mix evolving over the next 3 to 5 years? So we're going to start with Chris Kendall. So Chris, why don't you tell us first?
Thanks, Len, and thanks to the Stephens team for having me on this today. I'm looking forward to the conversation. When I think about the energy mix and how that's changed, my view is that really everything that we're doing right now needs to be looked at in a framework of a path towards decarbonization. And as we've seen the energy mix shift somewhat, where in particular wind and solar have become much bigger contributors to the global energy mix, we need to move further, and that's something I think that'll be interesting in the coming years. I see wind and solar continuing to grow, but probably not as high of a rate as in the past. And we'll see some new energy sources come in. We at Denbury in particular are interested in carbon capture and what that can do to the energy mix. For example, an agreement that we recently executed with Mitsubishi is to help them in a project that provides blue ammonia, or ammonia that's generated where the carbon dioxide is put underground, and you have a product that can be used as an energy source without emitting any carbon dioxide. I think we'll see more projects like that will come into the future, and what I see as the next wave of how the energy mix evolves as we continue to work to decarbonize the economy.
Very interesting. So let's go to the other Chris. So Chris Leary, you're down there. Let's hear from you.
Hi, good morning all, and thanks again also to the Stephens team for hosting today on the panel. I couldn't agree more with the statement. I would say dizzying is the right word for it. There's a lot of stuff going on the energy transition. However, we here at Orion Infrastructure Capital have been investing into environmentally innovative assets, I guess, before this last wave or so over the last 2 years. At the highest level, the biggest comment that I'll make is we've seen a lot more equity investment opportunities into all things sustainable infrastructure and energy transition, and less activity, obviously, around things that are tied to conventional assets or asset classes that support hydrocarbon consumption. As a response to kind of the macro theme of having more equity investment opportunities, we actually launched a new business focused on addressing these equity investment opportunities that support sustainable infrastructure and the energy transition. And it's an exciting time for us because we find it that some of these businesses are at a point of inflection. They're not quite yet accepted as kind of asset classes that are in the middle of the fairway, whether that's CCUS, hydrogen, distributed generation or storage, or other renewable and sustainable asset classes. So what we do here at Orion is we try to help these business or project owners get their project or company to the next level where it's commercialized and fully accepted by the market and can access lower cost of capital. However, when we think about the word environmentally innovative as we describe our investments, and 80% of our investments that we've made to date are what we call environmentally innovative. There's also still room to kind of address your ESG and sustainability goals while further decarbonizing and making more efficient conventional energy assets. So as we know, the energy transition is a transition. And I think a lot of folks in the market are actually overlooking the opportunity to make conventional infrastructure assets cleaner, smarter, faster, and have a lower carbon footprint. As we've done with a handful of our assets, for example, helping a company implement and develop its electric pressure pumping fleet that reduces diesel consumption and emissions as well. So, I think there's a different number of ways to look at the energy transition and the different opportunities associated with it. Some are tied to innovating around conventional infrastructure assets, while there are more equity opportunities to further develop new sustainable infrastructure and transition assets.
Wonderful. So let's hear from the renewable side, Tom and Donald. I want to get your perspective. Tom, why don't you go first?
I'd echo a lot of the sentiments around the room, and thanks to the Stevens team for having us on and participating today. I think the next 3 to 5 years are going to be an acceleration of what we've seen over the past 12 to 18 months. Things like carbon capture, not just in its own right, but also adding carbon capture to existing renewable energy projects. We're going to see expansion there. I think green hydrogen, as we've heard from Japan and Europe, is going to come more into play here in the U.S., particularly as we look to progress from renewable natural gas as an energy transition source into even more sustainable electrification, grid infrastructure, and additional power sources that provide that decarbonization that Chris mentioned.
And Donald, do you have anything else to add from the CleanBay?
Yeah. So when we started out initially, the RNG was actually, one of the focus areas was to make power from RNG. And in the European situation, renewable natural gas started off as a power generation source. Wind and solar have very much won that race, and now RNG has evolved into being, a transition fuel in many ways, whatever way you look at it. And how we see the next 3 to 5 years evolve within our sector of the RNG piece, we see the hydrogen piece evolving more. Obviously, just a transition fuel for transportation, that's going to be its big role. But of course, it also can be used to charge in certain locations for creating electrical power for EV charging as well. So we see a significant evolution. Like all energy sources, renewables won't stay steady either. They will keep evolving as well, and the uses of those will keep evolving over the years as we evolve into those as well.
Wonderful. So that's a great look at the factors and the goals. So let's take a look at possibly some of the barriers that might come up. Can you all address how much shortages, price spikes? We've seen that lately. Geopolitical events have been a concern. So why don't we go with Chris Leary first, and we'll go from the investment side.
Sure thing. So you can't help but notice price spikes, whether it's WTI crossing $80 recently, or European gas prices at $40 an MMBTU. So, I think that really what it does is highlights the fact that the capital markets and private capital markets in particular have really shifted away from their investment into conventional assets and have really gone full on assets that are going to be supporting kind of the energy transition here moving forward. However, I think folks have forgotten the fact that this is actually a transition. It won't happen overnight, and conventional infrastructure assets are still required for the foreseeable future. Now, I think, as I mentioned earlier, it's our challenge to figure out ways of making them smarter, better, cleaner in terms of how we operate things like CCGTs or pipeline infrastructure. And it is not a flip the switch model in order to get to net zero. I think the grid, obviously, as most folks on the call understand, requires pretty significant overhaul, immediate storage solutions, further electrification, and I think, as many folks may agree, kind of the advancement of hydrogen infrastructure at a lower cost. But until that happens, we still need to continue investing in conventional infrastructure in a way of decarbonizing the assets that we require today. But the volatility in price has actually created some investment opportunities as well. For example, we have spent a lot of time looking at and analyzing investments into merchant battery storage opportunities, across various different grids that can, capitalize on the volatility and pricing that's been created by renewables being introduced to the grid without the proper storage associated with them. I think it highlights, in short, the fact that the energy transition is in fact a transition. It's not a flip the switch, and the volatility created by it does create opportunities for investment as well.
So Tom, what about from your point of view?
So from CleanBay's perspective, there are a couple interesting points on this topic. We're developing utility scale bioconversion facilities that leverage a organic biomass input in the form of poultry waste, specifically poultry litter, and we effectively repurpose that through mechanical and chemical processes into large quantities of renewable natural gas currently, as well as an organic fertilizer, natural fertilizer product. So we're caught right in the middle of agricultural, geopolitical issues, energy, oil and gas issues, environmental issues, et cetera. I think COP26 can't go unnoticed. There's a lot of rhetoric, and I think it elevated the conversation. It'll remain to be seen how governments, institutions, investors, et cetera, implement any of the findings and discussion that happen there. We're certainly in a number of discussions with groups that have made, climate pledges as part of that process. Being huge construction infrastructure development projects, certainly we pay very close attention to supply chain issues, which we have seen some disruptions in schedule. Pricing escalation on materials and construction have escalated through the roof, but currently we're starting to see a little bit of stabilization, probably a long time before we see pricing coming back down, particularly given labor shortages on tradecraft and the like. So we also see opportunities in some of the recent geopolitical events in the sense that we're starting to see a lot of large institutional bilateral carbon trading off of the carbon registries. So they're peer-to-peer, large-scale contracts long-term, which is great for a business like CleanBay. But we will have to see how the rest of the so-called climate pledges and climate adaptation plans unfold over the next few years.
Donald, do you have anything to add with that?
One of the other interesting shortages, or maybe shortage is the wrong word, but adjustments we may see is throughout the next number of years, you're going to see every country in the world trying to become more carbon neutral. And if we looked at what's going to happen as a result of that, a lot more components are going to get more difficult to find, especially for large scale wind and solar, but actually capital may become constraints in some marketplaces. If countries start to compete with each other and governments start to compete with each other, that who can give the best tariff and who can give the best protection to get the flow of capital into countries, that actually could create another pressure that we don't see presently. And that's why I think we could really find something that could challenge projects going forward as well.
Right. So, and Chris Kendall, so what about from the your point of view?
You bet, Len. And I'm going to double down a bit on Chris Leary's comment. I mean, just talking about this energy transition as not being a switch that can be flipped, I think is important. If we look at the energy complex today, over 80% of the world's energy supply comes from fossil fuels. And that will change, but it will take many years. And even in the most aggressive scenarios, by 2050, we still have significant hydrocarbon production as a portion of the world's energy mix. So we need to recognize that and take it into account in all of the transition steps that we're thinking through. A good point that Chris made was related to the electrification of pressure pumping and what that can do. And those are the steps that I can see, whether it's reducing emissions in completions, like in that example, whether it's reducing flaring, reducing other emissions in oil and gas. There are steps that can be taken along the way as we work through this transition. But recognizing that it's a long-term transition, hydrocarbons will be needed. We need to provide those hydrocarbons at a lower carbon intensity than we have in the past. And of course, at Denbury, when we use this captured industrial CO2 to produce oil, we produce an incredibly low carbon intensity oil. And again, for us, that fits right into this transition that we see taking place over many years.
Right. So Max, let me get your insight on this from the Stevens perspective and what the Stevens team saw throughout 2021 from an investment banking perspective.
Sure, Len, I'm happy to do so. I think from our perspective, there's really been a confluence of events that you really need to understand. The first one is public support for environmental issues. That has become a very important part of the conversation. The second one is really government mandates, whether they be state, federal, or municipal. Those have also been important in the context of driving the conversation. And obviously, corporate sustainability initiatives have also been accelerating the demand for low emission and power generation. I would also say that COVID has had an impact, given the fact that for the first time, people had time to evaluate what was happening in their environment, and that has driven much of the conversation. The administration, the current administration, has had a very significant impact on this. The $1.2 trillion infrastructure bill, which was passed in November, is going to provide significant public funds to support the development of renewable technologies, including hydrogen, which we discussed a few minutes ago. If the Build Back Better legislation were to be passed, that would include approximately $555 billion of capital set aside for climate provisions, of which $320 billion alone is going to be towards clean energy spending and tax credits. So clearly a huge impact as well. From the perspective of energy companies, you're looking at oil majors embracing circular economy. Fossil fuel utilization continues to drop. It's expected to decline from 80% today to about 50% by the year 2050, which highlights some of Chris's perspective a few minutes ago. And while oil use is going to be flat until 2025, we will be seeing gas utilization continue to increase through 2050, which is going to represent approximately 24% of the global energy supply. So the message here is that fossil fuel is not a zero-sum game. Fossil fuels will continue to play a significant role despite the fact that you have sustainability and environmental issues impacting it. It's a critical component of the energy mix. It's just going to be much more lower. And obviously, one of the major areas that will be impacted will obviously be coal. Coal is expected to have the largest shrinkage, with utilization down approximately 62% by the year 2050 from today's numbers. So clearly a huge impact as we look at it.
So Chris Leary, I want to go back to you then on this infrastructure issue. So obviously we've talked about a lot here. So what role does infrastructure play at Orion Infrastructure Capital, particularly as a catalyst to that route for net zero? And are you guys seeing certain sectors of infrastructure becoming less favorable to invest in as it relates to these net zero goals?
Yeah, no, absolutely, Len. And, the ones that come off top of mind as being required in order to get to net zero is, continued investment in all things solar and wind. Energy efficiency doesn't necessarily get a lot of airtime, but I think it should, as we move forward with existing assets. Continued electrification, whether it's vehicles or other things like green pipelines, is definitely something that needs investment. And obviously, as we think about, getting further to that net zero with base load power and other, consumption related to hydrogen, I really do think that infrastructure needs to be built and developed. However, I think, as we mentioned, this is going to take the course over the next couple of decades in order to really get to that net zero goal. And what that's done is kind of created a little bit of rhetoric around the uninvestability of certain asset classes like upstream oil and gas, like midstream, when folks are trying to meet their sustainability goals. So we've seen a lot less capital, a lot less M&A activity associated with anything upstream oil and gas. There hasn't been as much growth in the midstream sector, which is kind of a derivative of upstream oil and gas. And folks are even straying away from things like CCGTs or other conventional power assets. Look, I think they will have less emphasis moving forward, asset classes like this, as we do transition, but they remain important today. And if there's ways that are creative and innovative to decarbonize the consumption and the operation of these, let's say, conventional infrastructure assets, it does still create compelling opportunities. Furthermore, I think what we've seen is some folks that have taken a little bit of a contrarian view on these asset classes, where they're able to make acquisitions or investments at attractive attachment points because there's really a big bifurcation between the capital available for conventional assets versus kind of anything sustainable and transition related.
So Chris Leary, let me go back to you then. So with ESG trends still evolving, what new or different ESG factors are emerging as drivers of the investment process at Orion Infrastructure Capital?
Sure thing. And, look, I think ESG and sustainability, they've become buzzwords recently, but, I think the way that we look at our investment process is to invest in sustainable businesses outright, not because it's a new trend, but only because it's a good business model. It allows us to mitigate some risk on, investing into asset classes that will more quickly become obsolete. So when we think about environmental innovation in our portfolio, it goes hand in hand with our sustainability goals by investing in businesses that will just be around and more profitable for longer versus conventional assets. What I would say is, a recent evolution in our investment strategy has actually been pushing further into kind of the social impact of our investments. As I mentioned, most of our investments, have a decarbonization and environmental innovation angle. But recently, we've actually made a handful of investments into sectors and asset classes that have a positive social impact, whether it was helping a large consumer products company vertically integrate their supply for pharmaceutical grade ethyl alcohol to support hand sanitizer production, or another capital partnership where we invested in a platform that manufactured hospital gowns and other PPE devices for the ongoing battle against the current pandemic. We do realize that a lot of times the E in ESG is all that folks talk about, and it's important for us to also push our emphasis on social infrastructure. We're not just talking about it, we're doing it. And we have various, kind of investment criteria that we target in order to hit kind of our broad goals. And, today I felt like it was important to highlight the social aspect of ESG investing.
My next question is one that I hear a lot, actually. And I'll go to Thomas and Tom and Donald on this. How has ESG moved from a cost center to a value driver for companies, both at CleanBay and the energy space as well?
Sure. Well, as an envirotech company, CleanBay really has ESG in our DNA. Not by design, but by fact. So following on to Chris's point, yes, we have significant environmental benefits in terms of carbon equivalent abatement through nitrous oxide specifically, which is a greenhouse gas that CleanBay has targeted specifically. But also that social element, which it manifests itself at CleanBay through economic development. So we're typically building projects and investing in very rural areas, low employment rates, et cetera. And when you look to make $500 to $600 million type investments for infrastructure assets in those areas, that comes with a lot of job opportunities, a lot of contribution to the area's tax base, which then translates into more money for education spending, et cetera. We look to partner with local institutions, universities, community colleges, vo-tech schools, create apprenticeship opportunities and the like. So what we're seeing is that beyond just parties interested in CleanBay's value proposition economically, but we're bringing more holistic benefits beyond just the additional environmental benefits. And that has really set our discussions around CleanBay apart from other renewable energy projects or renewable energy companies. That has been quite attractive to a lot of institutional investors as well as strategic investors from the utility and the oil and gas sector.
And Donald, how about you? What is your perspective on that?
Yeah, so to add, I'll speak more about the E part of that. You know, for us, the ESG, as Tom said, was not a cost center. You know, it was part of our business and part of what we did. We, through the nitrous oxide abatement and the avoidance of nitrous oxide emissions, we remove pollution from land, air, and water in what we do. Of course, that for us, where the evolution came here is we didn't have to figure out how to monetize that, because walking into Chris Leary's office and telling him I could solve land, air, and water problems, emissions wouldn't get you funded. So what we really had to do was look at that and how do we put a value on that. And the main thing for us around that was how do we put a value on the carbon element of what we do in the nitrous oxide emissions. So we actually ended up developing a carbon business intelligence unit within our company, where basically we can put a carbon value in almost any aspect of emissions that occur. And that's becoming a more and more interesting part of what we do as a business and how we progress as well. So that was, we are an RNG business. We're focused on the production of renewable natural gas and fertilizers. But the carbon business intelligence unit has actually evolved out of that as well, and is becoming more and more important, especially from an underwriting point of view and looking at the value of what we create in the environmental attributes.
So Max, let me go back to you then. What are some of the key challenges and the opportunities for the clients that you guys see at Stevens, that are arising during this transition to a low carbon economy?
So from an opportunity perspective, Len, we see a huge upside. If you look at the numbers, renewable power for the first time will overtake oil and gas drilling in 2021. We expect $16 trillion of investment through 2030 in that space alone. We also expect approximately $2 trillion a year investment between now and 2050 in the whole space. So huge amounts of capital is going to flow into it. From a discrete perspective, we focus on solar power, biofuels, plastic waste recovery, carbon sequestration, energy storage, EVs, and transportation. All of those sectors are very much in the sweet spot of what the gentlemen on this call have been highlighting. So we see huge opportunity there. From the perspective of the government, obviously tax credits, a push to decarbonization, continue to expand the requirements. From a challenge perspective, it's really more of a basic blocking and tackling. We always start with strong management teams. Do we have a strong management team that's going to be able to deliver what they are presenting to the market? The ESG, the G part, is obviously critical. Do we have the governance in place to be able to deliver and accept the amount of capital that we need to execute on the opportunity? From a platform perspective, which a lot of the people on this call are focusing on, is do we have the platform in play that will allow for returns to be reasonable or high returns given the technology risk, or are we looking at a merchant transaction? So those are some of the key challenges that we see as we go forward.
Okay, I want to move on to now financing the energy transition, a very important topic. So Max, let me go back to you. And broadly speaking, what sources of capital have been most prevalent in the alternative energy space right now? And how does that differ from traditional energy sources? So I guess what I'm asking is what financing structures, if any, are unique to this industry?
Frankly, the financing structures are not unique in the sense of a new structure has been developed for the market. These are more traditional structures that continue to be the the sort of the soup du jour. Private funds will account for about 80% of the financing in the market, with debt representing approximately 60%. We are beginning to see some corporates getting involved in the play directly to own the asset, to have a participation in the asset. So we're seeing big tech companies participate, for example, in energy storage, where they're investing significant amount of capital, whether they're also focusing on sustainable aviation fuel. Again, corporates are looking to lock down that stream of liquids for their marketplace. But from a perspective of buy side, I think we've seen on this call that we are seeing tremendous buy side interest on the alternative energy and renewable side. From the perspective of structures themselves, as I said, there's nothing here that's unique. It's pretty much down the middle. So tax equity, preferred equity, construction debt, and permanent debt will be kind of the main elements of financing as we go forward.
Okay, now Chris Kendall, let's get an operator point of view. So has investor focus on alternative energy sources and this interest in ESG focused platform impacted the way you perceive return requirements or risk appetite really when evaluating projects? So why don't you tell us why or why not?
You bet, Len. And I think that, a pretty good baseline is that investors are going to want to make a good return on their investment. And while the nature of the return we provide will come from a different source, I think we still need to be able to provide that. So I don't think that has changed. I think what has changed is the perception of how that return looks for an investor. Whereas in the past, when Denbury was more focused specifically on the oil production that came from our enhanced oil recovery process, you're really looking at quarter to quarter and some pretty near-term viewpoints from many investors. I think as we go into carbon capture as a bigger portion of what Denbury does, and ultimately the bulk of what we do as a company, what we see is that mirroring what many of our investors are looking for now, which is not short-term focused, but it's very long-term focused, recognizing that the path we're on is going to take years to really get to the point where we see these new projects come online and the growth trajectory of that piece of the business just continue. And so I say that is really the nature of how we're seeing it differently, is that a longer view from investors. And certainly from our standpoint, we love that. We're managing this company for the long term, not for the short term.
Right. Well, so then how exactly do you define Denbury's return requirements and risk appetites when it comes to clean energy transition?
You bet. And so we don't really speak to our return requirements. Those are something we keep internal, other than I'd say that they haven't really changed as time has gone on. What I would say is that the nature of the risks has changed. Whereas in the past, the real risks that we saw as a company were dominated by commodity price fluctuations, which we've all seen, and just execution on projects that bring that to bear. When we look at this risk profile in the future, going back to that long trajectory of growth and long lifespan of projects that we're working on, I think that the nature of the company looks different. And so projects that we're getting into that involve carbon capture from an industrial facility, for example, that's a project that once we tie into that industrial facility and we become the off-taker of captured carbon dioxide, that's a project that will last decades. And so in our view, that starts to present a different value picture than in the past, where you could even say it looks a little bit more like a midstream model, where you have that ongoing cash flow stream that will continue for many years, rather than depleting as you saw with and continue to see with straight up oil and gas investments.
So then, Chris Leary, how has Orion Infrastructure Capital seen competition change across the financing landscape for alternative energy? Given the increased interest in this space?
Yeah, there's no doubt increased competition and new entrants around anything ESG and sustainable infrastructure. And, that's made it a bit more competitive, especially in the middle market for growth stage companies where we typically do tend to invest. As I mentioned, there's been a lot of folks that have been wading into this sector that don't really have much experience investing in renewable or sustainable infrastructure. Some larger buyout funds have launched ESG-specific vehicles and so on and so forth. I think a lot of that capital, albeit is committed, will have trouble getting deployed at the return requirements that these new entrants, are expecting to hit. For example, you can't make PE-style returns or teen-style returns investing in wind and solar. Those days have long gone over a decade ago. So I do expect there to be a lot of committed capital that actually doesn't end up getting deployed from the private side. We've seen this come and go in the past. And another second point to point to related to new entrants, it's been the activity around SPACs. It's really hard to ignore, but what this has done, it allowed kind of venture and growth stage companies to leapfrog their typical progression in the private markets before going public. And this resurgence of SPACs and anything electrification or circular economy or ESG related has been a center of focus for some of these acquisition vehicles, and they've attracted sky high valuations. However, I don't think that's actually a sustainable source of capital because we look at the companies that actually have done this leapfrog process, and a lot of times they're not more than just an idea with some customer interest. So we expect that Orion's permanent, semi-permanent partnership capital will become more attractive in the long term because we actually do find business owners that are looking for an experienced partner to grow their business, to get it de-risked and to a certain stage where they're able to capitalize on a more valuable sale once their platform's more mature and not race for the exit. I think long term, I think that's how value will be created for these growth and post-venture stage companies. And it's also another reason why we've launched our equity vertical in order to kind of capitalize these businesses that are looking for more sustainable growth and a partner like capital investment.
So Tom, then the other place that this has attracted attention is obviously the regulatory environment. So what role have federal and state regulations played in incentivizing or motivating companies to finance energy transition projects?
It's a great question, Len. So there's no question that federal and state level incentives have played an important role in renewable energy project development. If we look at solar and wind, 10 years ago, we wouldn't be at this state of calling those projects, typical infrastructure projects today without those type of incentive programs, whether it's renewable energy credits and the state level renewable portfolio standards, which continue to increase their demand for this type of decarbonized energy. In the transportation fuel space, the low carbon fuel standard in California, the most lucrative market currently, has attracted, I think, the attention of every project developer producing renewable natural gas and some hydrogen for that matter, and biodiesel. And it's also captured, the attention of investors and has become a primary focus point. As we see those programs expanding in the transportation sector, Oregon has a low carbon fuel standard program that actively trades. Washington State just passed legislation last year, and they're in the process of implementing a program. Canada is actually implementing a Canada-wide clean fuel regulation, which is currently underway. New York has a bill in the Senate for additional transportation and heating fuel from decarbonized sources. As these additional programs come online, you're going to see significant pressure or competition amongst them for limited pools of decarbonized fuels. That's going to create a lot of opportunity for developers and owner operators like CleanBay. It's also going to, I think, provide more stabilized insight for investor underwriting, particularly downside underwriting, which has continued to be a challenge for a lot of investors that we've met along the way. I think a key aspect there is going to be the need for institutional investors to expand their internal regulatory and carbon modeling capabilities, because those programs and being able to model carbon and monetize carbon are going to be instrumental in the underwriting process. And that's only going to grow over time because these programs are going to become more complex, more complicated, and much larger than simply a transportation fuel subsidy or market traded product. Interestingly enough, we are seeing expansion in the tradable futures and options market for example, the California LCFS. As well as some of the RGGI related, type of activities. Europe is expanding publicly traded instruments as well. So hopefully that'll start bringing a lot of additional clarity and comfort to the investor community that doesn't really certainly didn't exist a year ago and is still in its infancy and growing today.
Oh, thank you for that, Tom. So we've had a great conversation so far. So these final questions are going to be for everyone. And we're going to start off with, I want you all to discuss how the mindset and demands of investors or limited partners have changed over the last few years with regard to energy transition. So why don't we get the CleanBay view point of view first, Donald or Tom? Can one of you start us off?
Yeah, so on that one, it's actually, it's evolving as we speak today. We're seeing one of the challenges for development of projects such as ours, RNG or maybe wind and solar, is that very few PE firms especially underwrite carbon directly. They'll underwrite offtakes from third parties, but you have a lot of firms that call themselves ESG, but very, very few underwrite carbon. And I think until we see the evolution that these firms can underwrite carbon directly, not underwrite an offtake by another large balance sheet, that's when we'll really see the momentum and the pivot of a really rapid expansion in the overall carbon market itself for all products associated with that. We're seeing it happening slowly. We're seeing more and more firms understand what the future of carbon looks like. Ironically, the oil and gas firms are probably one of those that understand it best and have a better longer term view. But if you look at the LCFS program and look at some of the future pricing that the oil and gas companies are putting on carbon going forward, and then look at the CI scores and bring them all back to where they coalesce together, actually a lot of them are very, very close. The pricing is very, very close to it. But until what we see, until LPs and actually limited partners are ahead of the PE firms we've seen here in this situation. But until these guys start really understanding what the value of carbon is, you won't see the really rapid expansion within the marketplace.
And Tom, I don't know if you have anything to add there from CleanBay's point of view.
No, I think Donald hit the nail on the head. The strategic investors, particularly oil and gas, I think the utilities are catching up just because of the nature of their business, had the resources, have the tools, and understand the carbon market and really the relationship between carbon and energy. So I think they've got a leg up, and I think that's why we're seeing actually a lot of partnerships that involve investment institutions and strategic companies, because that really, in the current short order, brings together the real expertise and capacity that's needed in order to underwrite particularly large utility scale projects, right? On-farm projects are a much different risk profile given, a $10 to $20 million investment as opposed to, something really focused on decarbonization at utility scale at 500 plus million, a $2 billion portfolio. So that's going to take time to evolve, and that will then lead to increasing the tempo of deployment of projects.
Chris Leary, what do you have to say about all this?
Yeah,
Yeah, sure. So from our perspective, I think what's changed over the last 3 years or so is that responsible investing is no longer a nice to have, it's a must have, put very simply. It's good news for us. I mean, we've been pushing our ESG policy internally, and, we're a signatory to the UN PRI. We firmly believe that sustainable businesses are good businesses, as I mentioned before. Taking that a step further, we've actually seen some LPs, shy away from any type of exposure to conventional energy assets and are only interested in investing in the energy transition. I think that is a common theme across sources of capital, where folks have actually made the decision not to fund businesses that are associated with hydrocarbons. And that's kind of created the capital dislocation that we referred to during the course of the conversation. So like I said, ESG and energy transition is a must-have for folks that are investing into energy infrastructure. And, even some investors have made it very clear that exposure to certain asset classes are no longer permissible.
So Chris Kendall, then how do you respond to that?
Sure thing, Len. And I'll start with an example. I think back when I first took this position back in 2017, and I was speaking with investors about the incredible potential of carbon capture and how Denbury in particular was well suited to lead in that. I got a bunch of blank stares back when I talked about it. It was just honestly not something that was important or relevant to investors at that time. Today, the bulk of our investors only want to hear about what we're doing on carbon capture, and it is just completely flipped along the lines of how Chris has talked about the positioning of investors changing. So I see where we are today as an industry, and especially in the hydrocarbon producing sector here. If you don't have a path that shows how you are contributing to decarbonization, even as a hydrocarbon producing company, then you're not relevant to investors and honestly just off limits for so many of them. And so I think it's just imperative to lean into this energy transition, recognizing that it is a transition, but that we need to take tangible, realistic, credible steps in that direction.
And Max, what are you seeing from Stevens's vantage point?
So I would echo both Chris Kendall, Chris Leary's perspective. 5 or 10 years ago, everybody was talking about solar and wind and not necessarily talking about ESG, climate change, decarbonization, et cetera. Today, every single investor that we speak with has either a strategy or is hoping to have a strategy of investment in the space. And what we're seeing is a significant change in some of the traditional players, whether it's a utility, which is now thinking about turning themselves into an energy company. And how do they do that? Well, they go into green hydrogen, they go into transportation in industrial segments and infrastructure that enable electric vehicles. So the utility space itself on the power side is very much focused on this point. When you think about the oil and gas industry, circular economy is sort of the must-have, as has been pointed out already. And what does that mean? Biofuels, renewable gas and biomethane, hydrogen fuel, carbon sequestration, and utility and storage have to be part of the conversation before investors will even look at those. I think at the end of the day, investors, besides the fact that they, as Chris Leary points out, it's not a nice to have, but a must have, they're going to look for returns that are commensurate with their traditional return expectation. So that's where the rubber hits the road, where you have a demand for this circular economy play or ESG play, but they're not going to take a discount to their investment criteria. So that makes capital interesting, but it also makes projects or opportunities much more interesting because there's not that many that are filling those needs that the investor community is expecting.
Okay. So Max, let me ask you then to lead us off on this last question, which is kind of similar. We've talked about it here, but over the next few years, then where does this leave us? Well, what will the pressure to find carbon neutral or carbon negative investments be, and from investors and LPs?
Well, I think it was mentioned just briefly a few minutes ago by Chris. You're seeing pension funds and insurers forming alliances. So the Net Zero Asset Owner Alliance has been formed to basically battle climate change they're pledging to be carbon neutral by 2050 in their investments. A recent poll found that 40% of the institutions plan to reduce their oil and gas investments over the next 5 years. So clearly, as I said, investors are very focused on this space. Now, where do they find those opportunities? I think on the electrification side, I think we've made the comment already that solar and wind have played out. EVs and charging infrastructure is still very much in play. Tremendous growth opportunity there. Biofuels, for sure, a huge opportunity. And obviously CleanBay can speak to that, as we go forward. Carbon sequestration, a very interesting opportunity as well. We're starting to see some very unique plays. So for example, where you have stranded assets, in this case, natural gas or methane that's being flared in some of the major basins, you're starting to see businesses being formed around taking advantage of that and producing cryptocurrency, and Bitcoin is an area that's becoming much more prevalent. So you're going to see the innovation here of American ingenuity really take place as we go forward and really try to bring together the needs of both investors as well as companies.
Well, Tom and Donald, as Max said, you're in that space. So what are you guys seeing in this regard over the next few years?
Yeah, just to kind of enhance what we said earlier, we see the LPs driving the money managers to actually underwrite carbon directly, and not to underwrite it through a third party's balance sheet and or offtake agreements, but to back projects based on the amount of carbon sequestration or carbon mitigation through whatever source that they're actually doing in terms of tons of carbon. So as companies and as managers get more sophisticated in understanding that, they will be able to demand capital directly from their LPs and to continue that work. And we see, especially in the RNG space, because RNG by its nature is quite complex. And if you add into that the LCFS program and many of the complexities associated with that, it's a pretty complicated structure to explain to anybody. Whereas if you bring it right back to tons of carbon, as in CleanBay's example, we are mitigating about 1 million tons of carbon per annum per project that we construct. And if you put a value of $50 or $100 a ton in carbon into the future, it's very easy to calculate the actual value creation that occurs per project we have. Whereas if you try to explain that to an investor through the LCFS program and the calculations within that and all associated with that, it's a lot more complicated. So we believe that as it goes more directly to carbon and understanding underwriting carbon, it gets more simplified for the LPs to come in directly through their managers.
Tom, anything to add?
I would add that really the tide change that we've seen, and I think everyone participating here has touched on this in one way or another, is that LPs in particular, and consequently, and institutional investors have had to really execute from a environmental and sustainability strategy, as opposed to LPs having sustainability goals, et cetera. Now that they actually have an environmental sustainability strategy that is dictating how their money is to be deployed. I think as that plays out over the next few years, we're going to see beyond just, for example, carbon, and addressing carbon, we're going to see full resource recovery type of strategy included in investment opportunities, meaning waste to energy projects, for example. So yes, you're abating carbon or you're doing carbon sequestration, but you're also recycling what used to be a waste that had to be disposed of and could cause environmental issues on its own. into sustainable products, whether that's energy, fertilizer, or other agricultural projects, food, recycled plastics, et cetera. And I think that's going to be the exciting opportunity to be part of the future here going into the next 5 to 10 years. And I think it actually presents a great opportunity for investors like Chris and Chris, who are at the forefront here of further expanding their platforms that can accommodate these new requirements driven from strategic direction.
And a great segue. So let's hear from Chris and Chris. So Chris Leary, you go first.
Yeah, I think moving forward, as we've kind of alluded to here, there's going to be an increased emphasis on ESG and clean energy and decarbonization. But I think the key theme to keep an eye out for is actually the being more specific with the criteria for folks' ESG goals and decarbonization goals. I think there's a variety of different templates and structures on what a good sustainable investment might be. It depends who you ask. And I think that more standardization around, hitting E, S, and G goals is going to be kind of forthcoming here. I know that some of the credit rating agencies already started adopting and trying to define some more standardized templates. And I think, if you ask 10 different LPs what their sustainability goals are, you'll get 10 different answers. So I think kind of having more standardized criteria on what folks are looking for when they think about sustainable investments or, funding the energy transition and decarbonization. I think we're still in the early innings and all that. And I expect that as investors, now become acclimated to the asset class, they're going to, dig a little bit deeper and start being a bit more specific on what exactly they're looking for. Are they looking for energy transition, or are they looking for resource efficiency, as Tom alluded to previously? And what is success, in terms of hitting those goals?
And Chris Kendall, you get the last word here.
Sounds good, Len. I smiled a bit when Max was answering a moment ago, and he mentioned cryptocurrency, and just kind of reflecting the challenges that we have providing energy in this world. Just this weekend, I was reading about the energy demand for Bitcoin mining. Today is about 0.5% of total worldwide energy demand. Who would have thought that a year ago or 5 years ago? And it's just representative of the growing economy, the growing challenges we have in this world of providing energy. I think about 1 billion people on the planet who don't have access to any electricity whatsoever, or 3 billion who don't have access to clean cooking fuels. And those challenges need to be met, and the decarbonization challenges need to be met at the same time. So I think it's an incredible challenge. I think on the oil and gas side and hydrocarbon in general, we talk about scope 1 and 2 emissions, our direct and indirect emissions, but certainly as hydrocarbon producing companies, these companies need to also consider the scope 3 emissions, the actual emissions associated with the combustion of the petroleum products. That's something we're very focused on, and we see a path to being net zero even on that basis by the end of this decade. But I think for relevance going forward and to provide that attractiveness to investors, any of these companies in the space need to be looking at that full carbon footprint and how that can be offset in order to better position themselves for the future. It's an interesting, exciting future, but many challenges and competing needs that I see in the future here.
Certainly is interesting. Well, thank you, everyone. What a really thought-provoking exchange of ideas we just had. It's wonderful speaking with you all. So this does conclude our Stevens Investment Banking Energy Transition webinar. Again, I'm Len Vermillion, Editorial Director with Hart Energy. Goodbye and have a wonderful day.
Stevens, an independent financial services firm, has a long history in the energy markets and is highly regarded for its sector expertise and prudent client advice. Over the past decade, Stevens has continued to affirm its industry focus, growing its dedicated energy and clean energy transition investment banking team to more than 20 professionals and completing over 200 transactions. The team creates innovative solutions for the vast ecosystem of companies that power our country, covering a number of key industry verticals such as upstream, midstream, energy infrastructure, energy management, alternative, renewable energy, and more. The combined knowledge of the energy and clean energy transition team enables Stephens to provide clients an unmatched level of investment banking service, including mergers and acquisitions advisory, fairness opinions, and public and private debt and equity offerings.